it's difficult to measure liquidity, but I can say that if money was really tight, Bitcoins wouldn't make a new high. Gold wouldn't make a new high. Silver wouldn't make a new high. The stock market wouldn't make a new high. And the bond market would be acting better because in a tight monetary environment, the bond market would smell that the recession is going to happen. But no, the bond market is actually acting badly. In other words, the bond market doesn't have much confidence that money is tight. In fact, as they cut rates after September 2024, in an environment of Fed fund rate cuts, the bond market should rally somewhat, but no, it didn't happen. So,
Go ahead.
my view is that money is actually plentiful. And many analysts have been wrong about the stock market because they thought, oh, money's tight. If money was tight, the dollar would be strong.
Right.
That is the clearest sign. And, I'm telling people, we are in an environment of monetary inflation. And in monetary inflation, it's very difficult to measure. Say, I have portfolios, they are valued in euros. I have portfolios that are valued in dollars. And I personally, I look at essentially asset prices in terms of gold and silver and platinum, because I think that is the fair reflection of the rate of price depreciation in terms of purchasing power. And when I look at all these things, the stock market, some people say, oh, it's making a new high. Nonsense. Making a new high in nominal terms, but not in euro terms, not in gold terms.
Right. So about all of that, I would 100% agree with you, actually. I just need to comment about that. I see liquidity in this system, and you fully expect that to continue. So it's hard to, correct me if I'm wrong, so it's really hard to bet against stocks because of the liquidity. Is that what you're saying?
Yes, I think that is the conclusion, that in the current environment, it is conceivable that stocks stay at this level in America or even go up, but that the dollar goes down. So you should be short dollar rather than stocks, I suppose.
Right. We talked about, you mentioned the bond market. Do you see a lot of stress in the bond market, or do you fully expect another quantitative easing or buying, I should say, with the Federal Reserve buying the longer end, the longer bonds, because to provide liquidity into it?
I don't see any stress because the credit spreads are very narrow. If we had stress, then the credit spreads would widen considerably, but that hasn't happened. And the bond auctions are actually quite strong.
Yeah.
That's why I'm telling you, I think when people talk about liquidity having tightened, they're wrong. I don't think the liquidity is tight at all.
Yeah, I would 100% agree. I don't think it's tight at all either. And I think that's reflective in the markets, if you would. There's so much money flowing into the markets.
Look, take my case. 5 years ago, on my liquidity, and because of the nature of my business, I have liquidity. And of course, not everything is in liquid assets. I have also investments. But on the liquidity, I was getting zero interest. Now I get 4.5%. My cash flow, my liquidity position has actually increased. It's a joke because most people are struggling, but mine has improved.
Yeah.
As an
So,
economist, I don't like it. As a private investor, I love it.
yes. Yeah, well said. Um, so really, where are you looking to put money then? What to protect yourself and your portfolios against this monetary inflation and liquidity that you have? But it's also hard to find deep value now. Is that correct?
Well, I think if I look around the world and stock markets, what strikes me is that for the last 10, 15 years, say after 2009, low was in on March 6, 2009, S&P 666. After that, the US market has performed superbly. And European markets, and especially emerging markets, and specifically Hong Kong, China, did miserably. So we have an environment when if you ask people, well, what do you do? The investor has to decide, does he buy the stocks that are making new highs like Nvidia that are highly priced, or does he buy the depressed sectors in the market? In my view, he should buy the depressed sectors, mostly the emerging markets, because there's nothing particularly good about emerging markets except they are relatively inexpensive. I mean, I live in Thailand. There's nothing good about the Thai economic political situation, but the country functions and the asset values are relatively low. The market has been going down. This year, we're down something like 20%. And I think if you buy, say, Thai stocks or you buy Hong Kong shares, over 5 years, you will have a reasonably good return. I mean, I have been telling people, and everybody in Hong Kong knows me as Dr. Doom, because during the boom in Hong Kong, I was very negative about the real estate market. But now that property prices are down so much, and we have deflation in China, so the price level has become is not cheap. That I want to make clear, but relative to other cities in Europe and America, Hong Kong is now more affordable than it ever was before. So I think that Hong Kong offers investors with an opportunity. Singapore, the same.
So you're still finding a lot of, or you see a lot of value, and you put money in the emerging markets such as Singapore. And I hate to call them emerging markets because I don't think they're no longer emerging.
Of course not, but they are. I group them into emerging markets because they are within emerging economies and
Right.
frontier economies. But I also look at Latin America, and I think in Latin America, we have an opportunity in countries like Brazil, Colombia, Chile, Peru.
I'm going to comment real quick about, you talked about the high in 2000, I want to say 2007 or 2008, and then the low in 2009. I have a really good friend, an old friend of mine that's an accredited investor who subscribed to your report. And we were talking about you in 2009, and you called the top. And then he immediately interrupted me. He said, Marc Faber also called the bottom. That was back in, I said, so well done. So
Yes, I was lucky because Bloomberg interviewed me in 2009. Huh. And I told him that the mood, actually, the interview was on March 6th. And at the time, the mood was extremely negative. And I have, at the time, I had close contact to other strategists like Rosenberg and fund managers and so forth. They all say the S&P, at the time it had dropped to 666, the S&P will go down to 400. And I told Bloomberg, no, in my view, the market is bottoming right here because the mood was so negative. I pay a lot of attention to investor sentiment. It's like in Asia. Until, say, 3 months ago, foreign fund managers were selling Asia. There were 2 or 3 fund managers that were buying Asia, but very few. They were selling Asia. And now suddenly these characters are waking up and they say, we have no exposure to Asia. We better buy something. So then they buy the blue chip stocks, the big market cap stocks. And we had big moves in stocks. And I think at the moment, everybody was very bearish about Thailand. I think the market is bottoming out here in Thailand.